Yes. So first, basically, we're explaining the structure of the financial system. Financial system has got three main parts. The financial markets, where people buy and sell financial assets. You've got financial intermediaries. Okay, these are the people in between. They link the saver and the borrower. Okay, because remember, in the financial markets, the purpose of the financial markets is to connect savers and borrowers. Okay, so the intermediaries are the ones who collect money from the savers and give it out to the borrowers. Okay, so financial intermediaries, you've got banks, insurance companies, and you've got also pension funds. Yes. So like for example, a bank, whenever you go and deposit money in there, the bank will keep a certain fraction of that money, and then it's going to loan out that money to businesses or even government. Okay. Then the third component is the financial regulators. The Bank of Zambia, the Securities Exchange Commission. Okay, these regulators make sure that everything is going according to the book or according to the rules and the guidelines. They are like the watchdogs to make sure no funny business is happening. Okay, so that's what you need to remember. This is the structure of the financial system: financial markets, the intermediaries, and the regulators. Next, we're explaining the role and the functions of the financial system in the economy. Alright, so first one, moving money from the savers to the borrowers. Okay, so the people the borrowers, they need, like for example, a company. The reason why a company borrows is so that it can either expand its operations, buy new equipment, so that they can produce more. Now remember, these companies are part of they contribute to Zambia's gross domestic product. Okay, you've got the mining companies, you've got manufacturing companies. All of these companies, even government, basically, even government also borrows. So these companies and government, they can get money from the financial markets. Okay, companies, they can sell shares or corporate bonds. Whenever you buy shares or corporate bonds, the company is now going to use that money for its operations to expand and produce more. Okay, government, it's got treasury bills, treasury notes, treasury bonds. When you buy those treasury bills or treasury bonds or treasury notes, that money is used by government to help the economy. Government now can build new infrastructure, right? Hire more teachers, police, immigration. Listen. So as government is hiring more teachers, immigration, it means people are getting employed. Because remember, what runs an economy is money and spending. Okay, so if government, for example, sells treasury bills, treasury bonds, and treasury notes, when they get that money, they'll build new infrastructure. As they're building that new infrastructure, people are getting hired, unemployment levels are reducing in the economy. Alright, when businesses borrow money to expand their operations, it means they're going to produce more. The more they produce, that helps the gross domestic product of the economy. Okay, so that's number one. They move money from savers to borrowers. Okay, number two, they make it easier to buy and sell goods and services through the payment systems. Yes, even like for example, if you want to buy shares on the Lusaka Securities Exchange, there's now an app on your phone. Okay, you can buy shares through your phone. So when multiple people buy shares through their phones, that company gets that money. And as I said, when the company gets that money, or when the companies get that money, they will increase operations, hire more people. Okay, unemployment levels go down, gross domestic product goes up. Yes, theoretically. Okay, all of this is theoretical. Okay. Number 3, it allows people and businesses to manage risks. Okay, especially through insurance. Okay, there are many risks that can harm a business. That's theft, fires, floods. So you wouldn't want a big business, for example, one of the biggest mines, something should happen, maybe a fire enrages it. That mine, the country wouldn't want that mine to stop its operations. So through insurance, that mine obviously will have fire insurance. Through insurance, it will be able to rebuild its buildings or its factory and then continue operations. Okay, theoretically. Okay, so yeah, businesses, even government, there are risks always involved on a daily basis. So businesses have to manage those risks. Okay, you have also got inflation risks. Okay, exchange rate risks. Okay, what else? Even interest rate risks. Okay, these risks are detrimental to businesses and government, and once they pause production, it means the economy is going to suffer. And then finally, providing ways for people to invest and grow their wealth. Right? So yes, if you buy shares in a company, or you buy, let's say for example, especially treasury bonds, long-term, those are long-term government securities. Okay, you'll be earning interest, and that interest you can be saving it. Okay, so that you better your life. Okay, because an economy needs a lot of people with income in there. As I said, what runs an economy is spending. So if there's little income within the people of the nation there, the economy suffers, because if no one is buying goods, then businesses can make their profits. Might need to cut down production, affecting GDP. Okay, if I'm speaking on a base way, majority business, I'm not just talking about one, majority. Okay, if people in the nation don't have income, the income levels are low. A lot of manufacturing businesses, or even service offering businesses, they'll have few customers. And when they have few customers, they produce less or offer less services, which can affect gross domestic product. And it means now they might need to lay off workers, meaning unemployment levels increase. Okay. Yes. Explain the process of financial intermediation. So financial intermediation is where you're connecting a saver and a borrower. As I said, when you put money in a bank, okay, the bank will use that. We're going to loan out that money. For businesses that need to use that money, okay. So that's financial intermediation, basically. There, the business and the person who saved, they've been connected through the bank. Okay, that is financial intermediation. Okay. Or even if you go to a mutual fund, okay, and you invest your money in there. They say that mutual fund, okay, professionals are going to buy bonds and shares for you. You're going to make a portfolio and you're going to get a small slice of that portfolio. So now, those investors and professionals who've made that portfolio, they've bought shares and bonds and even treasury bills. So that money has now gone to the borrowers, who are government and businesses. Okay. So that mutual fund has connected the people who are pulling in funds into it with the businesses and government who need to borrow that money. Next, the economic functions of the financial markets. These are the main ones. Price discovery, they help determine the price of shares and bonds through supply and demand. Okay. Prices are determined in the financial market. Okay. Liquidity, converting your assets into cash. Okay. Liquidity, as I said, once you can easily convert your assets, for example shares or the bonds, into money that you can use, then you can spend that money. Okay. So these financial markets offer liquidity. You can buy shares or bonds or various securities. Those securities, you can sell them and get your money back whenever you need that money. Okay. You can sell them. Finally, reducing transaction costs. As I said, with the new systems in place, okay, you don't even need to. A broker might be needed, but you find the transaction costs have been low. The transaction costs we're talking about is whenever you're buying these shares and bonds. Okay, especially if you're using a broker, the broker have to get his certain percentage, right? Even ZRI will have to get a certain percentage. Okay, so there are a lot of transaction costs that occur, but the financial markets have made life easier in this century. A long time ago, the transaction costs probably were even more. Probably you had to go physically to the securities exchange to buy from there. But nowadays you don't need to go to Lucy and buy anything. You can just buy it on your phone or on your computer. Then these are the type of financial markets you need to know. Primary market. This is where these financial instruments are created, like shares. Okay, whenever a company issues out shares for the first time, that's what we're talking about. That's the primary market. Okay, if a new company forms today and it now issues shares, that's the primary market. Okay, so this is the market where securities are sold for the first time. Then you have the secondary market, where existing securities are being traded, like the Lusaka Securities Exchange. Okay. Then you have the money market, okay, for short-term financing. This is where you have the treasury bills. That's where if government wants to raise short-term financing, it sells treasury bills. Okay. Companies, they want short-term financing, they issue out commercial papers. Okay. Banks, they are what we call certificates of deposit. Okay, where you put in a huge amount and the bank tells you you can't use this amount for this whole year, because the money market, remember, it's only for a year and less. Okay? So a certificate of deposit, maybe you put in a big amount, and the bank tells you for this whole year you can't remove that money, because they know that all of that money is going to be borrowed out, either to a government or business. Okay, then when a year elapses, you get your money back with some nice interest. Then you've got the capital market. This is where long-term securities are sold. Shares, corporate bonds, treasury notes. They're not limited by a year. They can go. You can buy them and own them for more than a year. Then you've got the derivatives markets. Remember, colleagues, a derivative is a contract whose value is based on a certain asset. Okay? Derivatives are one way of protecting you from certain risks like exchange rate risks, interest rate risks. So I have notes on those, on the derivatives. Yes. And then here we've got explain the different types of financial instruments. You've got debt instruments, the treasury bills, certificate of deposit, bonds. Okay. These debt instruments pay you interest. Okay. Then you've got equity instruments. These they don't work like debt. Equity is just, we're talking about shares basically here. Shares are paid dividends and they do not mature. Debt instruments mature. Okay. These mature. Equity instruments don't mature.